What is up, ladies and gentlemen? Going live here with a very special guest today on the Monday Market Update. My name is Sean Grapevine. I'm the Vice President of Product Strategy here at UMortgage, and I am blessed with a very special guest in a certain Jon Arnsmeyer. Jon leads our Lock team. If you're not familiar with that is, it's these loans, we got to lock them. They got to get locked in at a certain interest rate, certain fee structure. And Jon alchemy turns lock requests into locked loans. Really excited to have him on today and talk to him about sort of the process there, like what that means to a consumer, how economic news turns into benefit, or Jon, what's the opposite of benefit?
Detriment.
Detriment, man, to the consumer. Jon, welcome aboard.
Hey, good to be on with you this morning. It's been a while.
It has been a while. How was your weekend?
It was fantastic. Just a great weekend, Home Depot, Bed Bath & Beyond,
Wow.
Standard midlife stuff. How was yours?
Propping up the American economy through locks and locksmithing, maybe. I don't know. Something like that. Yeah. Nice. I spent the weekend with the in-laws in Florida. You can tell by my sun-kissed, or like sun-slapped appearance. I will say it is inhospitable to human life down on the Florida Panhandle right now. I think the humidity is over 100% somehow. There's like a oversaturation.
I get it. It is the Sunshine State.
That's a good point. They do have a reputation to live up to. Unfortunately, they're overdoing it.
That's right.
They're like anyway. Oh, they're overdoing it. I got heat stroke just a couple times, but I recovered just in time for us to be able to kick off a rousing Monday market update. Before we head into the shape of last week, let's go over some of these numbers here. Interest rates down. Did you know? I mean, that's what the chart says. You would know better than the chart. Our interest rates, in fact, down.
They are ticking down ever so slightly, ever so steadily.
Yeah, if you look, it's starting to sort of take shape on this graph here. I think the most sort of telling one is going to be the blue one. That's the 30-year fixed. And no, I guess that's it's going to be the purple one. They really have been slowly but surely dipping.
That's right. And not only that, the cost for those rates or discount points are also slowly coming down as well, because we're starting to see more premium in some rates. So the price that any consumer is going to pay is starting to change as well. So you asked, in the lock world, how do I see things? It's rate and price. I'm just going to put that on the table now. I'm bringing the heat right off the start.
Whoa!
But I'll let you take it from here.
We're in multivariable calculus, and it's only 5 minutes into the show, ladies and gents. Right. Strap in. We've definitely had a reduction in rate, and the reason, well, there have been multiple reasons for this, and they're really if you're used to the Monday market update, there are 4 or 5 things we really take a look at. We take a look at CPI, so the inflation. We take a look at PPI, which is inflation for producers. We take a look at the jobs numbers. There's a lot of different jobs numbers. There's job openings. There's ADP job reports. There's the initial jobless claims that come out every week. There's the big job report, the jobs report, I guess is what it's called. And all of those, plus your various forms of inflation, plus things like retail spending, which comes out tomorrow. And then also GDP, which I also think Q2 comes out next week, all point to how people perceive the eventual decisions to be made by the Fed. Now, when things are bad, Jon, did you ever listen to Modest Mouse, the band?
I did. I am of that generation.
Okay, good. I had Matt Gouget on last week, and he didn't know what I was talking about. My favorite album by them was Good News for People Who Like Bad News. You remember that album?
I do.
That was their, I think, a seminal entry in their discography. And here in rate land, right? Bad news, right? It is good news for us to a certain extent. So whenever job whenever, unfortunately, whenever people lose their jobs, whenever people stop paying as much for things, and whenever the GDP, right, like the gross domestic product of the United States goes down, that means that people think the Fed is going to respond by reducing the cost of money, which should spur economic activity. So that's why I like the good news for people who like bad news for us rate hawks out there. And John, we've had a lot of good news for people who like bad news over the past few weeks.
Yeah, but I'm going to go back to something you brought up. CPI came in at 3% last week, which, that means that, again, for our listeners, that, it rose 3% year over year, or month over month. The expectation was 1%. The Fed is still targeting that 2%, but that shows us that inflation is continuing to come down, which is good news, and that will portend to maybe something you're going to bring up, and that is the potential for the Fed rate cut coming down the line. I'm just jumping ahead of the gun, but
we're gonna
these are things that are right on the tip of my tongue.
Perfect segue. You're like Job from Arrested Development, cruising down the street on his Segway into a discussion about interest rates. So before I pull up the CME Fed Watch tool, which is really cool if you haven't seen it, it returns the dreams, the fever dreams of traders the world over into predictions about what they think is going to happen in upcoming Fed meetings. Whether is the Fed going to reduce interest rates or increase interest rate? Well, they're not going to increase, or are they going to hold them steady? So we'll pull up what the experts think, but I want to hear what the expert thinks. Are you team one rate reduction, 2 rate reductions, or 3 rate reductions on the year?
As I don't know if you remember this from previous conversations, I tend to be more conservative, and I would anticipate 1 in the rest of 2024.
It's an unpopular opinion. I agree with you. I agree wholeheartedly with you. And the more I look at these charts that are coming up, the more I start to doubt myself. Go ahead.
Oh, well, you asked about bad news, and I think like that's the thing you have to look at is like, I think a lot of people are feeling those job losses. They're feeling the price that they're paying. What was it? CVS or Walgreens announced that they were going to cut their prices by, some crazy percentage a few weeks ago. And it's like,
did they?
Everything they did. And so I just think if you step back, you're starting to see all of these Fed rate increases over the last few years, and then keeping it higher for longer. The accumulation is starting to build up, and we're finally starting to see the bad news, which is the good news. As good news for people who like bad news, as you said. And so that's going to lead into the rate cuts, because it's finally at a critical mass where it's there.
So yeah, we're going to get to what traders are thinking about this like further down the year, and it's very surprising to me, and it also is having a very surprising effect on the 10-year, or actually not an effect. And we'll get to that in a second here. But we've got the 31st of July Fed meeting coming up, and we see here that 87% of traders think there's going to be no change, and then 12.9% are very optimistic and think there will be a reduction. I mean, if we've learned anything, it's that the Fed is going to telegraph a rate cut far in advance of it actually happening. They are not in the business of surprising people. They tried it a few times and it went horribly. The market absolutely pitched a fit. So I mean, you don't think your 1 rate cut will be as early as July, I assume?
No, I think September is that sweet spot that they're looking at.
I think that you'll see. I have a couple of predictions coming up. And remember, folks at home, for those of you guys who've been watching, I'm wrong all the time. Not all the time, every time. So 100% of the time, I'm wrong most of the time when it comes to these predictions. So bet against me and you'll make money. You'll see that other people agree with you. 84% chance of there being a rate reduction in September. Only 3.5% of people think there's not going to be there's going to be no change. Now, to me, that's like a little foolhardy. And then you have this same group of people. This group of people have now moved 1 bucket over. They lost a couple of folks on the way, and now think that it's going to be 2 rate reductions, which I think is absolutely improbable and insane. Now, I think that, like we said, the Fed likes to project. They like to telegraph. So my guess is, and tell me if you agree, that on July 31st, my parents' anniversary, by the way, they are going to, in the Fed meeting minutes, which is the sort of notes that come out afterwards. Jerome Powell, he chats about, what they, he doesn't really chat. He delivers a very prepared statement about what they talked about. That is when they are going to plant that first little seed of not just the fact that there's going to be rate reductions, which they've already planted, but that there's it's going to be a time bound seed planted.
Correct. But the thing that I want to put on table, again, Sean, and thank you for having me on, this is my perspective on this, is through this whole battle with inflation, the Fed has been more stubborn, and they're staying the course longer than people anticipate. And so when you and I see market movement, we think, oh, this is really good. But Jay Powell has proven that they're going to stick by their guns. So that's why I'm like, they might do one and then announce more in 2025. It's just going to be higher for longer, I think, is the old overall message that they're going to continue
we're on the same page. I think we're getting old, John.
We are.
We're old fuddy-duddies.
Mm-hmm. Because and here's the thing is, in terms of like how we talk to our clients about this, is it's really nice to be able to say, hey, rates are going to come down. And we all want to be the Barry Habib. We all want to deliver good news and rate predictions. But there's some cautiousness to that. There's some, especially in this time, because this is very unprecedented. So it's like, hey, as you've pointed out, the market really thinks it's coming to September. And I think that's true, but I just think we need to take it meeting by meeting.
Yeah, I agree with you. And I do think, though, when we do get that little piece of news on July 31st at like 2:17 p.m., my guess is the 10-year goes from whatever it's at right then, let's say 4.18 to 4.22, down to 3.9 in that half hour. The first time,
I would 30 seconds.
Yeah, first time the Fed actually gives a date of like telegraphing, because the other thing that they don't do is they don't pull back. Like once they give something time bound, they typically don't try and pull the rug out from underneath traders' feet unless there's very, very strong evidence to the contrary in terms of numbers that come out along the way. But like we've even seen great, like we've seen numbers that come out to the contrary of where the Fed has telegraphed that they're going. And they're like, we're not going to, look, we already sort of gave you guys the hint. We're not going to change the hint. We don't do that. So if you take a look at November, there is most people think there have been 2 cuts by November, Johnny boy. We've got this same group of absolute wackos. Matt Gouget and I were like, we would love to have these people at like our party. Like they would be great. Like they'd be great on your team. But they shouldn't be in charge of making decisions. They're just in charge of like they're the personality hires of the group.
Right.
Like these people are just absolute whack jobs. These people are old fuddy-duddy, even more old fuddy-duddies than us. And then you've got December. So we've got a majority probability of a 3rd rate cut. Have we not been here before? Do you remember January, December? 3 rate cuts this year.
I remember, and that's why I'm coming into this conversation saying, hey, let's be more measured.
How far over your skis can you possibly get that many people think there's going to be 3 rate cuts? I mean, if there's 3 rate cuts, John, you're in trouble. You're going to have some tough days ahead.
It's good. It's good trouble.
I'm gonna remind you of that, and you're gonna hate me. You're gonna be like, I'm so busy. People keep unlocking and relocking the same loan 4 times at 6 different lenders. Oh my God, we're doing 5 times the volume we've ever done. I just want to go to sleep. And I'm like, oh, it's good trouble, John.
Right. Listen, I survived the refi boom of 2020. Bring it on, my friends.
So yeah, I think this is pretty like out of control. I don't really think that this is possible. I mean, but when I see a 4% chance of just 1 rate reduction, it does make me second guess in my opinion of just 1. I mean, are we that contrarian? Are we that smart?
This is just, you know what? I think we are.
Okay.
I think we're getting old. I mean, we're just at the point where we say, get off my lawn, and say, it's just going to be 1, because I would rather be wrong in the situation, if that makes sense.
For sure.
I don't want to say, oh, there's going to be 3, because then it just puts everybody in a bad position.
Yeah, I 100% agree with you. All right. Well, in the time we have remaining, tell us about like what you see when the Fed, when big interest rate moves happen. So when the Fed cuts rates or they announce a rate cut or anything like that, like how does the consumer, how quickly does the consumer benefit? How much of the reduction does the consumer benefit? Like I'm a client watching this, or I'm an agent watching this who advises my clients, and my clients are saying, hey, I know a rate reduction is coming up. When the Fed on September 18th announces or dropping rates 25 basis points, 0.25%, what's going to happen for me?
Right. So at that point, like right now, almost clients across the board are paying discount points for the rate. So I'm going to start there. And that goes back to what I talked about in the beginning. So you've got your rate and your price. And sometimes there can be a lender credit. Sometimes there can be discount points. That lender credit means you're getting a little bit of money back for that rate, or you're paying points for that rate. You're paying dollars. So as you've probably discussed over the last few months, is that the Fed impacts the Fed fund rates, which then impacts the lending institutions and what they're going to give out and their costs. And then that's passed along to the client. So how soon does that happen? I mean, whenever Jerome Powell speaks, the pricing changes immediately. And that can change anywhere from an eighth to a quarter, meaning you're going to pay.
These are very measured words from him. He's not like, we're thinking about 2 rate cuts. He's like, we're looking at CPI, and it is telling us a story that we are being very careful to analyze and it's like you're like, oh, they're not even saying anything,
right? And so the consumer on those days, they will see that in real time, because markets are already starting to, our investors, the people that the Wall Streets of the world, they're already starting to model out for this, and they know where they're going to move to. So they've already got their targets in mind. And so the client's going to feel that both in how much they're going to pay or receive for a rate. And then they're also going to feel it in the rates available. And so as you've been on the originating side, is it really goes into opening up the rate stack, because you might see that, like today, I think, it was benchmarked at 6.77. You might see a rate for a client that's really attractive that you just got to open that up. So how does it, long story short, how do they feel it very quickly, and they feel it generally on the eighths. In terms of price for that rate. So the rate might move a quarter as well, but then how much they're going to pay or receive for that will be impacted as well, which impacts their closing costs.
Interesting. Okay. So,
and I know I'm getting into the weeds on it.
So well, tell me this. So I have clients call me, right? And they say, I want to give me a quote. I've got great credit, let's say, 725 credit score, and I've got a regular job, and buying a regular house like that, median house cost in Atlanta right now is $410,000 or something like that, which is crazy. But I've saved up, and I'm putting 5% down. So just like I'm getting a conventional loan, or even an FHA. Let's say, I'm sure they track kind of similarly. If when the Fed announces that they're going to reduce rates, and then when they do reduce rates, what is that 6.77 going to look like on that? What's your, it's impossible to say. I'm so curious.
Right. You asked me that, my head explodes. Like I can't foretell the future, but let me say it like this. When the Fed starts to cut rates, those higher rates will have a better premium, a better rebate. And so think of it like a good that you're going to pay. This is the analogy I always use, is that rates are like a t-shirt. And then some t-shirts are nicer and some are worse. So, you've got your Walmart t-shirts up to your UMortgage t-shirts up to your, Vineyard Vine, Gucci. And so there's a premium you're going to pay for that. So like those higher rates, a little bit less desirable, but they're going to offer more rebate. Those lower rates, you might pay a little bit more. And that has to do with hedging strategies, things that are really in depth and kind of how you're looking at it. But as we talk with our clients and our consumer, that 677 in September, that might offer a really nice rebate, because that 677 might look more like a 625. And
come on, this is the good stuff. This is the juicy stuff.
So we start shifting down. Yeah. So like the same rate and cost at a very high level, what it is today is going to be lower. Everything's going to shift. So like, let's just say 677 today, 95% LTV, and I'm just spitballing here, is going to cost the client $2,000 in discount points. When that rate changes, when the Fed does lower rates, then you might see 6.25 cost that same $2,000,
Mm-hmm.
whereas 677 is going to, maybe give a lender
Give
credit back.
you
So,
three or 4,000.
Yeah, exactly. And that is how it impacts the consumer.
Interesting. So if you wanted to buy a house today and the only impediment right now was like concern that rates might drop in the future, would you wait?
I would not. And actually, one of our loan officers, Jay Bunty, had a fun little TikTok about that over the weekend, because when rates come down, there's a really good chance that the market's going to be flooded with people who have been sitting on the sidelines. So guess what? There's more people that are flooding the buying market. That competition is going to go up for those houses. So you might be getting a lower rate, but you're paying more for the house.
Right. Would you rather pay, $30 more a month because you got 6.75 instead of 6.25? But right. You missed out. You avoided paying an extra $40,000.
Right. Me personally, buy the house now, refinance lower.
I agree. Because the other thing is, like, there's the statistics I saw that I quote often, that's if you waited, last time interest rates were at like 7.7%. So that's what they were when I first looked at this this infographic. Basically, like, if you waited in 1969 when rates were at 7.7% for them to go down, waited for rates to go down, you would have waited until July 1993. So. Right. You can look at all the charts you want on the CME website, and you can rely on all the traders, and you can read mainstream media and alternative media that all says rates are going down, but they might not. And then What have you waited for?
Yeah, and then even if it just ticks on a quarter, the market will be flooded with more buyers. Prices are going to be higher, and the rates aren't going to be that much lower than what they are now.
Yeah,
so
exactly.
So we are getting old, Sean. It's just time to think, hey, longer and higher, longer for higher for longer. There we go. Yeah.
All right, guys, already locked too many loans, and it's 11:54 on a Monday. Well, I appreciate having you here. We'll set you loose back on those loans. I know pricing is coming out hot and fast, and you need to have your finger on the trigger. Jon, really appreciate you hopping on today with your expert opinions, insight, and prognostications.
I appreciate the time, Sean. You're the man.
Thanks, buddy.
See you. Take care.
See you, everybody.